Okay, this week in our financial accounting class, we're going to be looking at adjusting entries, which is the next step in the accounting process. I'm going to go ahead and type out the first four steps. Steps in financial accounting that really you would do in any business. And our first two steps could be back and forth. We got our T accounts. Remember we did our T accounts. And our second step was our journal entries. And again, we could put those back and forth. You could easily do the journal entries first or the T accounts first. Our third step, and I'm going to call this 2B or 2A, is to provide a trial balance at any point in your year. Maybe you want to do it once a month, provide a trial balance. You could do that. So it's not really a set thing that you always do at a certain time, but at any point you could provide a trial balance, which we had talked about in our last lesson. And then what we're going to look at today is our adjusting journal entries. And ultimately that'll lead to an adjusted trial balance, which is usually our final trial balance for whatever reporting period we're in. So that trial balance, this trial balance you could perform at any time. It doesn't have all of the entries, but typically your adjusted trial balance will have pretty much every entry you need to show your financial statements. So we got our adjusting journal entries, and then we're going to look at the adjusted trial balance. But this week we're going to mainly focus on our adjusting entries. And what those are things, and let's go ahead and scroll down here and kind of show you a few of my notes on adjusting entries. The reason we have adjusting entries in the first place is because with GAAP, remember GAAP is the rules that accountants need to follow. With GAAP and accrual accounting, we have to use the matching principle, which says that we need to record any revenue and expenses when they occur. Record our revenue and expenses when they happen, regardless of if cash is used or not. Cash could be, or it may not be. Doesn't matter with accrual accounting. We have to record the transaction when it happens. For an example, like revenue. We've already done this, and you didn't even realize it, that it was a matching principle. But if we do a job for somebody, and they're going to pay us later, we still record it now, though. We record the debit as the account receivable and our credit to service revenue. Even though no money was exchanged, we still record the revenue when it happened. Same thing with the expense. If I happen to buy something or my workers work for me and I haven't paid them yet, I still need to record it and show that I got the benefit of whatever it was, and then show as a liability that I owe money for that. And I need to show that in the year it happened, not wait until cash was actually paid. So that's what GAAP says. Now, for tax purposes, for most small businesses, and for really any business, tax purposes, you can use the cash-based method or accrual. You can pick. A lot of them will use the cash-based method because, especially for revenue purposes, they don't want to have to pay tax on revenue that they've earned but haven't received any money on. So you would have to be paying tax on money you really don't have yet. So cash basis taxpayers, for tax purposes, will a lot of times use the cash method. So if you hear companies having two sets of books, this could easily be why. One, they need to keep GAAP records. They need to keep their books according to what GAAP rules are. And then another set of books for IRS purposes with the tax. Now, with adjusting entries, there's usually two types of an entry. A normal entry, what we've already done. A lot of times these involve cash, possibly the purchase of an asset or an expense. And a lot of times we'll pay for it with cash or soon to be cash. That would be our normal entry. Something where we get something tangible, I pay for something, I get money, I know I'm definitely going to have to do a journal entry. Where things get a little bit tougher is to go back then at the end of the year or the end of the month maybe and remember to do adjusting entries. These entries do not necessarily have a specific thing that happened at a specific time. For example, if you prepaid some rent, you paid for December and January, you can't expense January's rent in the month of December. You just can't do that. You can't expense something for next year in this year's expense report. But what happens then when I get to the end of January? I still don't want to show I have a prepaid rent. At that point, I need to show it as a rent expense. And that's what an adjusting entry does. Adjusting entry moves that amount that was in prepaid over to your regular rent expense for the following year. But nothing really happened on, say, January 31st. I didn't make a payment on the 31st. I didn't get anything really on that day. So I just have to remember to go back and to update my prepaid account and to show that it's no longer prepaid, that I actually have used it. Now there are 4 types of adjusting entries that we'll find. The more difficult ones are usually over here, the deferred side, and I'm going to explain what I mean by deferred in just a second. But we will have deferred expenses, deferred revenues, accrued expenses, and accrued revenues are the 4 areas where some adjusting entries are usually going to take place. And notice they usually take place within an expense or in a revenue account. Because if I buy a piece of equipment on account, I'm still going to report that either method, if I'm using cash-based or not, because I'm getting something pretty large equipment. I'm getting something that I can touch. I know a transaction needs to take place. But with revenue and expenses, if cash doesn't happen, it's a little bit more difficult to know that I need to still do a transaction. Just like if somebody pays, if I do a service for somebody and they don't pay me yet, I still need to remember to go ahead and record that as a receivable. I'm going to be getting the money and as a revenue because I did the job. Okay, so let's define these couple terms here, and then we're going to look at examples for most of these. Deferral. So either a deferred expense or a deferred revenue. So, and then we'll swap out either pay or receive depending on what it is. Deferred means money was involved now. Either I paid money, the business paid money, or the business received money right now, but no work was done. No work was either given to me as a benefit, like advertising, or I didn't provide a job. I didn't provide a benefit to anybody as part of my service. So we're going to do the normal entry with these usually up front because money was involved. When cash is involved, I know I have to do a journal entry. It's only later that I need to update those journal entries and adjust them when it's not necessarily clear that that needs to happen. So we're going to remember deferred means money was involved up front, but no work was done yet. And then accrual is just the opposite. Work was done up front, so either I provided a service, the business provided a service to somebody, or somebody provided a service to me, but no money was exchanged yet. It's going to be later at some point in the future. So in that case, it's our adjusting entry that comes first. I got to show that the work was done even though cash was not involved yet. So I'm going to kind of refer back to this as we go through some examples. But the first examples we're going to look at are the deferred expenses. So let's look at the prepaid expense, a deferred expense and prepaid. So I'm going to pull up my second document to look at a couple of these examples. Okay. So my first example here of a deferred expense, a prepaid account. Let's say in November, I prepaid rent for November and for December. Or I didn't really prepay. I paid November's rent right now, and I also went ahead and just paid December's rent. Now, my employer or my accountant, they like to keep things on a month-to-month basis. So I don't want to expense out December's rent yet in November because I haven't used it yet. I want to expense it when it actually occurs. So now I've got to do, what's my regular journal entry? On November 1, what kind of an entry I'm going to make? I know I need to make something because I paid. I paid money. So I got to ask myself the two questions. What did the business get on November 1? I got the use of rent. I'm using it right now, part of it, $500. And the second thing I got the benefit of rent next month. So I can't call that an expense, because remember the two rules of expenses. Are you using it right now? And if I'm using it next month, I'm not using it right now. So it can't be an expense, therefore it needs to go into the prepaid expenses. So I have prepaid rent as one of my debits. Remember, that's an asset. And then I'm also debiting my rent expense to show the rent for this month in November. And then you ask the credit question, what did the business get? Or that's the debit question, what did the business get? The credit question is, how did the business get it? In that case, what did the business do to get prepaid rent and rent right now? We paid money, $1,000. So I'm going to pull this up on the T accounts and show it again. This is, remember, this is kind of like, this is not starting out a new business. This business has already been in effect for quite a while. That's why I put these X's here to say, hey, there was most likely some previous cash had to be, because I can't just start spending $1,000 if I don't have any. So what these X's are saying, we had a lot of prior transactions. We definitely have cash. So my two debits, I had a rent expense here for $500. And then I had my prepaid rent in the assets as well, or in the assets just like cash for $500. And then I credited my cash for $1,000. Now comes December 31. It's time for me to take the next step. It's time for me to show I no longer have any prepaid. I don't have any prepaid rent because I've now used December's rent. So what the whole goal here is, I want this $500 to be wiped out. I need it to go away and go somewhere else. So if I have a $500 plus right now, if I want the end amount to be zero when it's all said and done, I'm going to need a $500 negative to offset. So 500 plus minus 500 gives me 0, which is what my prepaid would be at the end of December. Well, if I'm getting it out of prepaid, it's got to go somewhere. And if the rent is no longer prepaid, it means I'm actually using it now. And so rent that is used now is a rent expense. So if this was November, this would be my December amount, and then my total would show the full $1,000 now being used for the entire year. But if I was only looking at November, I'd only want the $500. But if I'm looking as December 31, I want to show all of it. All $1,000 has now been used as rent. So now I can show my journal entry of what I just did on the 31st. This was my adjusting entry. I debited my rent expense because I've now used the rent. And I'm crediting my prepaid account because that's no longer, that $500 is no longer prepaid. I've now used it. Okay, the second item on the list was the supplies. And that's another type of a deferred expense, where I'm going to get something now, but I'm not going to quite use it yet. All right, so on July 1, we'll say, I went out to the store and bought a whole bunch of supplies, things that I'm going to use for the rest of this year and probably in the next year even. So I went out to the store, I bought $700 of supplies. All right, so I definitely know that this is an entry I need to make right now. It's a normal entry because I paid money. So my debit is to my supply account in the assets. I don't want to expense this $700 quite yet, simply because I haven't used all the supplies. Some of them won't be used till next year, so I definitely don't want to expense those. So my normal entry here in the asset account, or in the asset parent account, I have my supplies being debited for $700. And then how I got it by paying money, $700. So I can look at my T accounts. Here's that $700 I spent. And my debit here was to supplies. in July I spent $700 on supplies. I got $700 worth of supplies at least. And I can look at the T account to show that, yeah, I did spend the money here in my cash. Okay, so now let's go to the adjusting part. It tells us in December that at the end of the year, I need to go through, look at my storage, look at everything that's left, and count how much supplies do I really have remaining. It's probably easier to do that than to go back and count up how much supplies have I used. If I know I started out with 700 and then I know what's left, I can then do the math and determine how much I used. So I go into the storage and I add up all the paper we still have left, all the other supplies, and it amounts to about $150 of supplies that are still remaining. Well, if I still have supplies of $150, let's go here. If I still have supplies of $150, and I started out with 700, so this is my total now. I know I have $150 left of supplies, and I started with 700. I know I had to get rid of some supplies, and I've used it now. I got the benefit of it. If I just do the simple math, I can tell that I got rid of $750 of supplies. I got the benefit of those supplies, so I'm going to come over here, and I'm going to make a brand new supply expense because I got the benefit of those supplies. I'm not going to make it all nice and fancy like the rest of them. But my debit would be of $550. And that's what I show here on my journal entry. Debit my supply expense. I've actually got the benefit of those supplies for $550. And why? How did I get the benefit of those supplies? Where did it come from? It came from my supply account. I actually used those supplies. They were already paid for a long time ago. Now I'm just getting them out of the actual storage in that little storage type account called supplies. Because my storage is only $150 now. We go back to my T account, and that's what I counted up for supplies, $150, meaning I got rid of $550. Okay, the third one there on the deferred expense, remember we had 3 in the deferred expenses. The third one is the most complex, the most new stuff that we're going to learn on this adjusting entry stuff. And it has to do with our large assets. When I buy a large asset, maybe like a vehicle or a machine or any type of equipment, well, that's something that I'm using now, but it's not something that I'm just using this year. I'm going to be using it for a long time. Now, with that said, that means I can't put it in expense right now, which makes sense. I don't want to expense it all right now and then still be using it for the next 3 years. That would be unfair to this year to be putting way too much burden, way too much expense on this year's books, and then none for the next couple of years when I'm still using it. So what accrual accounting says you need to do is you need to expense that asset that we have put on our books, like the equipment, a little bit over its entire life. Instead of all of it in year 1, we're going to split it up evenly, or not necessarily evenly, but that's how we'll do it in this week's stuff. We're going to split our asset up evenly and expense it out a little bit at a time so no year has more than its fair share. So that's what I put here. We're going to be depreciating our asset. That's what it's called when we use it. We're going to expense a little bit at a time. We're going to base that on the useful life. And that's dependent on management. Management's going to look at that asset and think, how long am I going to use it for the business? Not how long will it be able to be used by somebody, but just specifically, how long am I going to use it before it's time for me to move on, upgrade maybe, get rid of it, get something new. So for every business, it could be a little different. For example, like for a delivery company, they may use their same vehicle for 5 years. However, if you're a company like a rental car company, usually you don't see rental car companies 5 years old still in the fleet. They get rid of them after about a year or 2 and move on and then sell it and get new ones. So their useful life would be a lot different, a lot shorter. And then finally, the last thing we need to know for this section is how do we actually get our depreciation per year? And when using the straight line method, that's one of the methods of depreciation, it's very easy. All you've got to do is just take the cost of the asset and divide it over evenly throughout its life. That's how much we're going to expense every year. So let's look at an example to kind of put this into play. So let's assume back at the beginning of the year we bought a new piece of equipment worth $10,000. And let's say we paid cash for it. And management has determined that it's a useful life of 5 years, a nice round easy number to use. So when I purchase this equipment, especially when purchasing with cash, I know I've got to make an entry right now. That's my normal entry. What did business get? We got equipment. What did I do to get the equipment? I paid cash. So that was my credit. Now it comes to the end of the year, at the end of December. Usually you do your depreciations just once a year. You could do it every month, but then it gets to be a little tedious. So we'll do this every year. So it's now December 31. I have now used my equipment for 1 year. So let's go ahead, well, before we do that, let's pull up our journal entry, or our T account, and show that here we paid the money for our equipment, and I have debited my equipment account here. So I have my debit and my credit. Now it's December 31 of the new year, and I need to now adjust my, let's move these over just a little bit. It's time for me to do my adjusting entry. It's time for me to show that I have now used my equipment 1 year's worth. And remember the simple equation, take 10,000 and divide it by the useful life, 5 years. That comes out to be $2,000, or 1/5 of the equipment's life. That's what I'm going to show as my debit, my depreciation expense. Notice I don't call it an equipment expense. I'm calling it what it is. It's depreciation. I'm using it a little bit at a time, and to the tune of $2,000 this year. So that's my debit. My credit is a brand new account that we haven't talked about yet, and it's our second contra account. Remember back, our first contra account was our dividend or drawing account. This one is a contra asset, which means it falls in the asset category, but it's opposite. Most assets are plus minus, but this one is minus plus. So let's look at where this accumulated depreciation and depreciation expense go on our T account. Let's do the depreciation expense first. So I'm coming over here to the depreciation expense. I don't know where the $550 came from, but I think that came from my previous one. My depreciation for the first year in December was $2,000. Therefore, that's my total. Pretty simple enough, showing that I got $2,000 worth of benefit from that equipment. Now I come over here to my assets, and I've got my brand new account. The accumulated depreciation account, it goes right next to your piece of equipment. They go hand in hand. So account 140, if that's equipment, their next number is going to be your accumulated depreciation, most likely. And remember, accumulated depreciation, I have it in red here, so that means it's a contra. It's a minus on the debit side and a plus on the credit side. And remember, our journal entry was to the credit. And I added $2,000. And this was, again, not for July, but for December. Let's say it's 2016. Again, let's put 2016. It's not working. One of the key words here as well is the term accumulated. Accumulated is what it says. So when we go into next year, and I have the journal entry, when I go into year 2, I'm going to have the exact same, and it didn't copy over very well. Let me copy and paste this. It's very easy. All I'm doing is just copy and pasting here. I have a depreciation expense. I don't know why that's. Depreciation expense for the same amount as year one, and my accumulated depreciation is the same amount as year one because I'm using it evenly throughout every single year. So if I would go to year two, if this was for 2016, or let's just call it year one, end of year one, and I call this year two, I would have another 2,000 here because it's accumulating year after year how much I've depreciated. Now, just the opposite of that is when I look at my expenses or my revenues. As we'll see next week when we have our next lecture, everything from my little column here at the revenue line and over to the expenses, all of these guys get turned into zero at the end of the year. They all get transferred, as we'll see, into my owner's equity column of retained earnings. So at the end of the year, my depreciation expense goes back to zero. So for year one, it's gone. I no longer have that. So I need to get rid of year one because it's going to go away at the end of year one. And for year two, I'm simply going to have $2,000 again as my depreciation expense. Not four. All I want to show is exactly what depreciation I used just this year in year two. There's another 2,000. So that's all it is. But over here in my accumulated, I do keep track of all of the years. And the reason why these two are put together is at any point, I may want to know what's the book value of my asset. The book value is simply the cost of your original equipment minus how much you've depreciated in total. So the book value is your cost minus your accumulated depreciation. So in this case, after 2 years, my equipment is only worth on my books $6,000 because I have a 10 plus over here. But remember, these are kind of treated like a negative in the overall asset category. Even though they're a contra account, but they're a plus, when I add them all up to my assets, these are looked at as a credit or as a negative in the overall scheme of things. So the book value is the 10,000 minus how much I've depreciated, which is which is 4,000, which gives me a book value. What that equipment is still worth on my books of 6,000. Now, the last thing that I wanted to mention with this before we move on, book value does not equal fair market value. It does not equal fair market value. Just because it's worth 6,000 on my books doesn't mean that's what I'm going to go be able to sell it for if I choose to do that. If I go look up my vehicle in the Kelley Blue Book, it could be worth 5,000, maybe it's worth 7,000. There's no relevance to what it costs on my books, what's still left of value compared to what it's really worth out in the fair market. So do not get that confused, that they do not mean the same thing. Okay, if you need to take a break, go ahead and always pause whenever you need to. That's the beauty of these lectures. You can come back. The rest of our lecture examples aren't nearly as complex. The rest of them should go quite a bit faster. So let's look at our next one here. And this is in our second quadrant, a deferred revenue. And we only have one example in this category. What it is instead of the business getting a benefit, like it was in the deferred expenses, now we're going to provide a benefit to somebody, but they're going to pay me first. They're going to pay me up front, just like how before I paid them up front, like with a prepaid rent. Now they're going to pay me up front, and then I'm going to do the work later. So here's a real basic example. Let's say I'm in the snow removal business, and I get paid $900 up front, December 1, to do all the snow for the rest of the winter. Now the winter, of course, expands over 2 months or over 2 years. The current year, and then on into the new year in January. So of course I need to do a journal entry up front to show that I got the money. And these are obviously backwards. I got $900 cash coming in. And then I asked myself, why did I get it? Well, I got it for that I'm going to do a job, but I just haven't done the job yet. So I'm going to go through and credit my unearned revenue. That is an example of a liability account. I owe somebody something, but in this case I don't owe them money. I owe them a service. So let's see how that works here on my, I've now kind of just went back to my regular T accounts. I erased all the previous ones. So here I got the money. And instead of counting in this revenue, I have to put it over here as a liability because I owe money, or not owe money, I owe a service to this company to remove their snow. And I owe them a $900 worth of service. Now let's say it's at the end of December, so the first month out of the 3 that usually have snow is now used up. I can now count a third, because I've used a third, it's been 3 months, I can now count a third of this revenue coming in as actually earned. So on my books at the end of December, I don't want to show 900 in my unearned revenue category anymore. At the end of December, I only want to show 600. So that means I've got to remove 300 and put it somewhere else. So if I look at my T account, I have 900 here on the plus side. However, I've now used 300 of it. I've now earned 300 of it. So it's no longer unearned anymore. So I need to take 300 away from this 900, which leaves me a total, obviously, of $600. Now that 300 has to go somewhere. If it's no longer earned, or if it's no longer unearned revenue, well, it's most likely going to come over here to earned revenue, or earned service revenue in this case, of $300. I provided a service for the first month out of the 3, so I can now count 300 towards my revenue account, which is what my journal entry was as well. Okay, now we're going to switch over to the other side of that big plus sign of the quadrants that I had. We're going to look at the accrued side. The accrued side is quite a bit easier, I think, than the deferred side, mainly because we've actually already been doing a lot of the accrued items and you just didn't even realize it. The only one that we really haven't done is my example here, example number 3. So with this with the accrued side, work is done up front. Either I provided the work, or I got provided a service, and then cash will be paid or received sometime in the future. So remember before with the deferreds, like the snow removal, I got paid money up front, the job will be done later. In this case, the job is done now. Either somebody's providing me, this company, a service, or I'm going to be providing a service to somebody else, and it's going to be done right now. They're going to pay me later. So let's look at this little example here. For a 2-week period, my workers worked, and payday comes on January 6th of $2,500. Now, payday also included the holiday of January 1. And so as of the 31st, my employees have earned $2,000 out of the $2,500 that they're going to be paid at the beginning of next year. Now, it would be unfair next year if I would put all $2,500 as shown next year as being worked. That $2,500 wasn't all worked in the next year. Most of it was worked this year. So I need to show that the work was done this year even though I haven't paid it. And it's just like what we always call when our employees work for us, we get a benefit. So that means usually it's an expense, and that's what it is here. We got the benefit of our employees working for us, which is a wage expense. And I'm only going to debit the amount that they have worked for this year, $200 or $2,000. And I'm going to credit a new account, very similar to an account payable, but we call this a wages payable. So account payable is when I owe money to an outside company or an outside individual. Wages payable is when I owe money to my own people for work that they have done inside the company. Notice that this is my adjusting entry. I did the adjusting entry first. because, again, no money was involved, so this is something I have to remember to do before the end of the year. So let's look at my opening numbers here. I had a wages payable, that was my credit, for $2,000. And I had a wage expense as my debit for $2,000. Okay. Now the normal entry on January 6th. On January 6th, I paid money. I paid the full $2,500, which means I no longer owe any money. And I got a little bit of a work done this year, maybe January 1. So I need to show that. The business actually got two things when we ask ourselves the debit question, what did the business get? We got two items. We got one, a reduction of our debt. I no longer owe $2,000. If this was December, in January, now when I have a total amount left for January, it should be zero once I've paid my workers. So one of the things I got was a reduction of my bill. And it was a complete reduction. I debited $2,000 to my wages payable. What I also got was a little bit of work this year. So if this was December, that would have been my total. So I'm going to come way down here because I'm starting a new year. This account would have been zeroed out. And into January, I have a brand new balance of $500 that workers have worked just this year. And so I need to show that as a debit. And then I need to show, well, these are the two things that I got that the business received. I got a reduction of my debt and a little bit of work now. How did I get it? Well, I got it by paying money. Cash would have been my final entry here as my credits. So I had a debit of $2,000, a debit of $500, and a credit of $2,500. Now, the last two items that do show up or can be an adjusting entry, I don't even have an example of these just because they're so common to us so far. Another type of one we just did, a accrued expense, would be if I bought a piece of equipment on account. Well, I would simply just debit the equipment and credit the account payable. I already know that I should be doing this because we've already done that. And my last example there in the last quadrant would be an accrued revenue. And that's an example of an account receivable. We've already done that as well. I know that when work is done, even if I'm not paid yet, I still need to record it. So I'm going to debit that account receivable and credit my revenue. And then when I get the money, I'm going to show that the money came in and I'm going to take it off my customer's bill, off of his account receivable. Okay, if this lecture did help you out some, please do hit the like button or comment on what you liked about it. That really helps me and encourages me to keep providing these videos. My next video will look at doing an example, and we're going to do a couple examples, but we'll do one at a time. The next one will be an example of these adjusting entries.